T1 Energy just posted 40.8% revenue growth to $250 million. But net losses came in at $36.9 million, and adjusted EBITDA on that same quarter was only $10.7 million. That is a 4.3% margin on a quarter with serious top-line momentum. So the question is not whether T1 Energy is growing. It clearly is. The question is whether G2_Austin, the flagship facility still under construction, is the road to profitability, or the thing currently standing in the way of it. T1 Energy reported second quarter 2026 results on August 12. Total net sales hit $250.1 million, up 40.8% year-over-year. The operating engine right now is G1_Dallas, which produced 935 megawatts of solar modules in the quarter, a real manufacturing number, not a projection. CEO Daniel Barcelo described meaningful advances in domestic vertical integration and pointed explicitly to the second half of 2026 as the target window for stronger operational and financial performance. Meanwhile, the Corning partnership was cited as a technology moat differentiator. Revenue in Q1 2026 was $177.6 million, so the sequential jump to $250 is real acceleration, not a one-time base effect story. The financial prints tell a split story. Adjusted EBITDA of $10.7 million is positive, that matters, but it represents just 4.3 cents on every dollar of revenue. The net loss from continuing operations was $36.9 million, and total net income came in at negative $43.5 million. Operating margin is negative 17.4%. Management held guidance unchanged, which AlphaOS flags as a conservative posture given the revenue acceleration. The company is managing expectations deliberately as G2_Austin capital expenditure ramps. Earnings per share came in at negative 16 cents. No forward estimates were disclosed in the release. Here is the causal chain. G1_Dallas generates the revenue and the thin EBITDA. That cash plus external capital funds G2_Austin construction. G2_Austin, once operational, is designed to add domestic solar cell fabrication, completing vertical integration. Full vertical integration cuts input costs and expands margin structurally. Until G2_Austin is live, T1 Energy is essentially a high-revenue, thin-margin assembler, not a fully integrated manufacturer. The profitability inflection is locked behind that single construction milestone. The bear case is straightforward, and it comes directly from the research. G2_Austin remains a development stage initiative. Every dollar of capital expenditure, there is a dollar that does not reduce the net loss today. If construction delays or cost overruns hit, the profitability timeline extends, and thin adjusted EBITDA of $10.7 million provides almost no buffer. There is also single facility concentration risk. G1_Dallas is the entire production engine right now. Any operational disruption there hits revenue immediately. Guidance was unchanged, which means management itself is not signaling acceleration yet. AlphaOS surfaced the margin tension that the headline revenue growth obscures, flagging the 4.3% adjusted EBITDA margin, the negative 17% operating margin, and the G2_Austin execution risk as the three signals that matter most here. The platform cross-referenced the Q1 sequential revenue jump and the insider buying signal in filings, putting the construction dependency into direct context with the financial prints. T1 Energy sits at the intersection of U.S. domestic solar manufacturing policy and the industrial supply chain build-out. The domestic polysilicon supply chain is a named dependency. U.S. policy environment and tariff structures directly affect input costs and competitive positioning. The Corning partnership anchors the technology layer. The automotive and sensor sectors appear in T1's relationship graph, suggesting diversification ambitions beyond pure utility solar. The broader backdrop is a domestic clean energy manufacturing race, where first movers with vertically integrated supply chains, if they execute, command structural cost advantages over importers. Three things to watch. First, G2_Austin construction milestones in the second half of 2026. Any delay extends the net loss period and tests liquidity. Second, adjusted EBITDA trajectory quarter over quarter. If it does not expand meaningfully as revenue scales, the margin model is broken, not just early. Third, guidance update at Q3 earnings. Management's conservative, unchanged posture will either get confirmed or revised, and that revision, if it comes, is the signal the market is waiting for. The full research on T1 Energy margin breakdown, G2_Austin dependency map, and earning signals is live on AlphaOS. Open T1 Energy at alphaos.finance. Research and analysis only, not investment advice.